Assocham APAS Knowledge Report. The copies have been distributed to all our dignitaries. At the hands of all our dignitaries, we will be releasing Assocham APAS Knowledge Report, that is Essentials of Investing in Corporate Bonds, a book on corporate bond market in India. A huge round of applause, ladies and gentlemen. Thank you so much. Now I request Mr. Ashwin Parikh, Managing Partner of APAS LLP, to present the address.
Good morning, friends. Like a good consultant, I still believe in PPT presentations. My involvement with corporate bond market, formal involvement, I must say, as a practitioner, I used to support a lot of players. But formal in the reforms began in 2011 when World Bank decided to appoint my firm, Ernst & Young, to look at the corporate bond market development process or the reforms in India. And the sponsor was, of course, Department of Economic Affairs and World Bank, and SEBI was the coordinator for the assignment. Believe you me, it's been about 7 years after we submitted that report. The developments in the market, the change in the market has been phenomenal. You know, all the effort made by the regulators, by the industry, seem to be fructifying. There are a lot of challenges, there are a lot of needs, but we seem to have really gone a long way in the last 7-8 years. Prior to that, we all know several committees were formed. They issued their recommendations to SEBI, to the financial regulators per se, but it didn't really happen the way it happened in the last 3-4 years. So many factors, perhaps banking, one of the reasons why, the credit expansion capability or capacity started gradually reducing, but it's a healthy development, all said and done. The initiative that Assocham took up began exactly 14 months ago, and I must say, with Mr. Chandan Kumar from Assocham working very hard on the initiative, and we went and met with Mr. Mahalingam, and I must make a special mention of Mr. Mahalingam, whose support, in this entire initiative has been substantial. He gave us the first idea of what the event should be. And friends, it's a pleasant coincidence that after 14 months, the whole thing began here in this hall at Four Seasons, exactly 14 months ago when Mr. Mahalingam did the chief inaugural address, and we had almost about 300 plus 50 participants in this hall. We didn't look back. Mr. Mahalingam kept on pressurizing us to keep on doing more things. We went to about 11 different centers, and we have a coverage of almost about 3,000 participants in all these 11 different events that we took across the country. We went to the main markets from where the investments flow. We also went to the secondary markets as well, tier 2 as we call them. So it's been a very happy beginning, I must say. Somewhere in between, once again, Mr. Mahalingam triggered an idea. He said, look, you are almost about 35 to 40 different faculty members who've come up on your events and who have really contributed a lot by way of their papers. And why don't you compile it into some kind of a formal report or a book? And we took up the challenge. We created this book. And the book is, it's the report at the moment. Soon it will be a book. And it will be offered to all the 3,000 participants who really participated, plus more. We'll send it to various other stakeholders as well. So it's been a happy beginning, I must say, and it's a continuous journey. The markets keep on developing. We keep on, therefore, making Assocham and APAS will keep on making the effort to really cover all the reforms and to highlight some of the challenges and some of the needs for more reforms. So that's the journey, and friends, I'm very glad that you all have been participating in this journey and encouraging us to do that. The book, let me just quickly turn to that. The book, we said, when we started working on the events as well as the book, the 11 that I talk about, we wanted to make sure that each and every stakeholder associated with the bond market, all the constituents must be present at these events. They should participate, they should deliberate, and they should really not only take away a lot of, let's say, knowledge, but also contribute a lot of knowledge. And that was the whole purpose with which we started those events, and now the book as well. It's a continuous journey. We'll keep on updating this book. Every time a major reform happens or major development happens. But I thought I'll give you the background which really created this particular book. Behind the book, I must admit, we read the APAS team, SOCHM team, we read almost about 65 reports and books, overseas and domestic ones, to really make a book that you are now going to have. So therefore there is a lot of effort that has gone in. Once again, Chandan Kumar and his team, my team comprising of 6 professionals, they all work for almost 4 months, dedicatedly to work on this particular book, and that's the background of this book. I'll just touch upon 1 or 2 aspects about the book, and I'm sure you will find them very interesting. You see, in order to make an effective market, there are 4 I's which are required. You need good investors to begin with, you need good intermediation, you need good issuers, of course, and then you need good institutions. So, and the institutions would include those who work with the issuers, or we work with the investors. They include organizations like rating agencies and the others, and then of course you have regulators and government also. There's a 5th I, and if anybody could really guess, we've wanted to cover that 5th I element in this. We've not been able to do so because we didn't get too much of a contribution from the members, on the 5th I, which is the instruments. We find that the number of instruments in this market are fairly limited. Now, of course, there is a development of new instruments. We're going to have masala bonds, and we're going to have hybrid bonds and things like those. But once again, they're still around the same theme, basically. So reforms in instrument is something which we have not seen so far. It should happen, basically. Because you have different sets of investors with different risk appetite, and they go to the market and they would expect, different elements of risk hedging, and they would expect. So in the absence of a strong secondary market, perhaps, we're not seeing too many instruments, but one day we will, I'm sure. And that's what we're trying to put in the book. These are some of the challenges looking forward to what a good, healthy development, a developed bond market would be. We've covered several topics in the book. I'm just trying to highlight some of the important ones over here. But, the need, of course, and all that was well established, but evaluating the development. It's something which I'm very sure that readers will find this chapter very interesting. We've actually covered the development and evaluation of the development. There's some places we seem to have gone wrong. There are some places we've done remarkably well. We've made an attempt to evaluate that in our book. And then, of course, the acceleration part, the last part, most important part, how do we really accelerate this bond market? It has to be a healthy, vibrant market, and how do we really go about it? So with that, friends, I thank everybody once again for participating and contributing in this particular initiative. Thank you so much.
Thank you so much, Mr. Parikh, for such a knowledgeable address. And now I request Shri Ashwin Kumar Chauhan, Managing Director and CEO of Bombay Stock Exchange, to share the industry perspective. A huge round of applause.
Respected Chairman SEBI Shri Ajay Tyagiji, Shri Balakrishna Goenka ji, Shri Ashwin Parikh ji, so Shri Navita Yadav, Shri Sanjeev, and finally the organizer and my friend Shri Narendra. It's a pleasure and honor to be in front of you. I'll just give you a perspective on what is the comparative size of the Indian financial systems overall. So the book also says, and overall we believe the total bond market size incorporates is around $300 billion. Around 287 is written, but just for the sake of simplicity, we take as $300 billion. The banking system size is close to $1.5 trillion. Give and take few $100 billion, but just for my perspective, I try to keep all these things in terms of those numbers. So The bond market size, sir, is $300 billion. The banking system size is around $1.5 trillion. So bond market is around 20% of the banking system size. And the equities market is $2.2 trillion. It used to be $2.5 trillion because of the rupee going down. It has become $2.2 trillion. But effectively, that is the number we are talking about. And equity is a slightly different instrument vis-a-vis the bonds. In equity, you are talking about the risk, participation of the business. The business risk is being taken because you are becoming a partner in the business. Whereas in the bonds, you are not taking the business risk, but you end up taking it. And that's where I think the story goes very differently. In the recent past, the book also says, we have also observed, Indian bond market has been raising more than $110 billion a year. Indian corporate bond markets is raising $110 billion a year. And that's a very interesting framework. BSE raises the largest chunk out of that in terms of the exchange traded, but also exchange listed. BSE is the largest exchange in terms of the number of issuance listed in bond market. So effectively, if you have a $300 billion of bonds listed and $110 billion you keep on raising every year, so you are literally sort of having to raise $100 billion, or one third you are raising, and some of that will also be repaid and reissued and so on and so forth. So that is the state, and those are the sort of perspective numbers if you look at it. Who requires funds from the bond perspective? It's basically the central government, the state government, the private sector, and PSUs. Of course, the municipalities also have come into play of late. So somewhere in the line, 2 weeks back, in the AIIB conference, the Honorable Minister of Finance, Shri Piyush Goyal, mentioned that India will require $4.5 trillion over the next 10 years for its infrastructure requirement alone. And that's a pretty large number. We have reached $110 billion a year just from the markets, only for corporate bonds. Can we raise our game to raising 450 or $500 billion over the next 5-7 years from the markets itself? Or can we do at least half of it, $250 billion? The rest can be done by the banking system. And that is what keeps me awake in the night, saying, how do we raise it? I mean, earlier, 5 years back, when I used to talk about $100 billion being raised by markets, very few people used to believe, but today is a reality. Last year alone, we raised around the listed bonds, new listed bonds on BSE were more than 7 lakh crores. Before that, actually, earlier year, it was much higher. Last year was slightly low, as Ms. Yadav said. And that's where, basically, how do we raise our game from $100 billion a year to $250 billion a year? And the other question which comes to my mind is, we have to raise this $4.5 trillion. Will it come from foreigners or will it come from India? In foreign situation, already FPIs are taking money out because interest rates are increasing, especially in the bond market. In last full year, the FPIs have been taking money more out of the bond markets than equities. In fact, last month, equities, more inflows are coming. But the bond markets are seeing a trend where interest rates are increasing across the world. And will we also be helped by foreigners investing in our markets? But is our own math, our own mathematics, is it going to help us raise this $4.5 trillion over the next 10 years? India, in a broad perspective, currently is around $2.6 trillion economy. We save 30% of the total GDP. That is around $780 billion. Assume it is $800 billion. Assume 7% growth, which is currently happening. In fact, today we are at 7.7, 7.8. Assume 7% growth over the next 10 years. India will save $10 trillion, 10 to $11 trillion. I am on conservative side. Out of that, we require 50% to fund this gap. And that is where, even if the foreign money comes, it's very good. But India itself, after demonetization and a lot of financialization is happening, we may be able to raise these funds ourselves. In addition, of course, if money comes from abroad, it's a great thing. But today, if you look, if you just extrapolate, we have an ability to raise those funds ourselves. And of course, many of these bonds will expire, they will have to be refinanced and so on and so forth. But overall, the fund requirement is going to be met even from within domestic savings, only taking 40 to 50% of the savings that is going to be. That's the first question which I had, that can we raise these funds, which in a sense the Honorable Finance Minister mentioned. In my calculation, we should be able to raise it. Of course, little bit will come, or probably large will come from foreigners, but even without that, we should be able to raise these funds. The FPIs, as I said, have been taking money out, and the question we need to ask is, post-independence and especially post-nationalization, we depended broadly on the banking system to fund corporates. Of course, many other things help about the SICA, the Sikh Industrial Companies Act, BIFR, AIFR, which ended up actually helping the even industrialists to go to banks even for higher rates, because there were advantages those things with that side. Now, with the IBBI coming into force, those advantages are now going to go down. Still, the banking system has an advantage over bond systems. Bond system, even China today, with such a large bond system, if one bond default happens, there is a huge panic across the world. It may, if our bond markets becomes larger compared to the banking system, even otherwise, like last year we had this MTech issue, and it created complete ruckus. If we cannot handle that as an institution, as an institutional framework, by increasing the bond market, we will have an issue. So to ensure, whenever you want to ride a car, first thing you check is the brake. That in case of a difficulty, whether you will be able to create put a brake on it. Similarly, for me, if we need to make our bond market 10 times the size as of today, then, or 20 times or 40 times the size, do we have that ability to manage on an institutional basis the defaults? Whether it will affect retail investors, how will the assets be taken over, and so on and so forth. So for me, that is one piece of puzzle I have still been thinking how to resolve. And the other part is, which are the institutions which we are going to use. The bonds, usually the government part, is still being primarily traded on CCIL. The rest is traded on stock exchanges. Do we need to have a single bond market so that seamless flow of money from risk-free to risk-based instruments keeps on happening? And that is a question we need to resolve at some point in time. HR Khan Committee has already mentioned that, and it has been accepted, the budget speech of the Honorable Finance Minister also mentioned about that 25% of the large borrowers will have to now start borrowing it from the markets. And that is going to give a lot of importance to the market. And for me, the markets are poised, the corporate bond markets are poised for a real growth. I would not be surprised, instead of $100 billion being raised today, every year, probably will go into territory of $150, $200 billion very soon. Which are the instruments that we'll have to use? That is another question that comes to mind. There will be pure NCDs, or there will be basically other frameworks that will be used, and those are the questions we can answer as we go, but more secure the better. Earlier in the bank situation, even today, we are trying to fund long-term project needs using short-term funds. It's a very strange conundrum which we have come into, and we need to resolve that. Our insurance company is going to invest in 25-year bond. In fact, yesterday, Honorable Finance Minister also mentioned about 25-year bond. And for me, we need to continuously worry that if insurance companies have long-term funds, can that be basically invested in long-term rather than using the CASA to fund for 25, 30 years kind of framework. And that is another conundrum. Of course, mutual funds, bond funds, and so on and so forth, that need to be worried about. Which are the intermediaries that will be used? Are the current intermediaries in the markets equipped? Or we need to have additional training given to them additional ways of doing things that is there that we need to impart. And that I think this kind of seminars do yeoman service in that framework. But intermediation part also will have to play a big role, because otherwise mis-selling and so on and so forth happened today. Also it was mentioned that we don't talk below sort of A grade. That is also primarily for the reason that anything then gets sold and later on when default happens, the regulator gets blamed. So we need to have an understanding and who can participate. Who are the participants? Like in today, we are worried about saying SME, in equities SME, you don't allow small investors to come in. In derivatives, also you don't want to have people who are not capable to handle derivatives, you don't want them to come in. Do we need to also create those kind of frameworks for higher risk instruments so that smaller guys don't come in who do not understand that type of risk? We need to worry about it so that we create a framework which is robust. The risk goes to people who are able to handle that risk and not to everyone and so on and so forth. The processes that are going to be used, we need to be worried about. Current processes of issuances, private, public, somewhere in between, there is privately placed, but exchange raised today large amount of sort of money is being raised using privately placed but exchange platform framework, which has come out very nicely. Last year we alone raised almost 2 lakh crore on that. Before that probably we raised 4 lakh crore. But how do we basically, whether these processes are correct, there is a prospectus framework which has to become more strengthened compared to what earlier it is, because we are trying to bring more retail investors and so on and so forth. Those are the issuances, those are the issues we need to worry about. Any enhancements required? I think Ashwin Bhai talked about the credit enhancement part of it. That do we need to have some framework, some credit enhancement can also be bought by companies which are coming into the market, so that there is a backup that is available. Of course, internationally, they also have trade default swaps and all, whether we are able to do it directly traded or having just the credit enhancement framework. The other part which is plaguing, because we have always this feeling that India bond market is not working. And that is because we don't have a vibrant securities, vibrant secondary market. We have a very good primary market today. $100 billion is not a small number today. Many of you might be hearing for the first time that we are raising $100 billion through the market alone. But the secondary market doesn't trade as much. That doesn't mean that other markets are trading so much. They also trade equally badly. It's just that if we have to have a framework that small chunks, small retailers coming into the market, we need to give them liquidity.